Welcome to the Stock Market Palantir. Today we are going to talk about GPS.
Right. And Hyperscale Data Inc., which trades under that very evocative ticker GPUS. It presents one of the most complex corporate stories we've seen in the microcap space in a long time.
It really does. I mean, this is an entity that's gone through a true corporate metamorphosis. It was DPW Holdings, then BitNile, then Alliance, and now it's anchoring itself in these, very high growth areas of AI infrastructure and, of course, a substantial Bitcoin treasury.
And that's where the debate really is. It's not about the past, but about its present structure and, I guess, its future potential. The fundamental disagreement we have today is this. Is GPUS a legitimate deep value asset play that's just waiting for a massive re-rating from the market?
Or is its exceptionally sophisticated capital structure just a perpetual value trap, basically engineered for continuous capital extraction from common shareholders? I'll be arguing the asset value and strategic torque thesis. I'm focusing on the company's current tangible holdings and its pivot toward these high-growth sectors.
And I believe the evidence overwhelmingly supports the opposite view. My position, the structural extraction thesis, posits that the financial engineering here, specifically the toxic anti-dilution provisions in their preferred stock, makes the common equity perpetually impaired no matter what the assets do. The structure is the business model.
Okay. Well, to establish my position, let's just look at the hard numbers, the value side of the equation. As of late 2025, the company holds a Bitcoin treasury valued at approximately $72.5 million. Now, when you compare that figure to the current market cap, that liquid asset base represents roughly 94% of the entire company's equity value. For a value investor, that asset-to-cap dislocation is, well, it's compelling. You're essentially buying liquid Bitcoin at a major discount through a public vehicle.
And furthermore, management has even given us their own valuation metric. Chairman Alt asserted an estimated net asset value, an NAV, of 47 cents per share, with the stock trading around, 24 cents? That suggests the common equity is undervalued by over 50% relative to their own stated book value. This discount creates a massive latent torque, financial leverage, that's linked directly to Bitcoin's price. A moderate move up in BTC could translate into an explosive nonlinear move in the stock, simply because the market would be forced to close that glaring valuation gap.
Okay, but I have to jump in here. While I acknowledge the existence of the assets you're citing, and that $72.5 million BTC treasury is a significant figure, we need to draw a crucial distinction right at the start. Accounting value does not equal shareholder value, not in this specific context.
How so?
The continuous issuance of capital just ensures the common stock is perpetually impaired. You mentioned strategic alignment, but let's talk about the ownership structure that makes those assets frankly inaccessible to the common float. The core problem, the real geometric risk, lies in the Series C and Series H convertible preferred stock. These securities are senior, and they contain what's known as full ratchet anti-dilution provisions. Now, this is not the standard weighted average protection that just moderates dilution. This is mathematically devastating. If the company issues any new equity, say through an at-the-market offering at a price lower than the current preferred conversion price, the conversion price of the entire block of preferred shares instantly drops to that new lower price.
You are focusing solely on the risk side of the balance sheet without acknowledging the operational torque. Look, beyond the Bitcoin, the company's made two key strategic moves that are clearly intended to move it beyond that microcap status and, justify a higher valuation multiple. First, the rebrand to Hyperscale Data Inc., and that ticker, GPUS, is a deliberate, necessary alignment with the AI infrastructure market through its Centenum data center. And second, the reconsolidation of the Gresham Worldwide Defense subsidiary adds a stable, reliable, non-volatile revenue floor. I mean, that maneuver boosted top-line revenue guidance to the $125 to $135 million range. So you have this dual structure, leveraging volatile Bitcoin upside while stabilizing the financials with defense revenue. That is the kind of strategic positioning required for appreciation.
Very neat strategic narrative, but the structure governing the capital overrides any operational success.
That full ratchet provision, it creates this perverse death spiral incentive. The preferred holders, who by the way frequently include Chairman Olt's private entity, Olt and Company, are protected. In fact, they gain exponentially more common shares with no additional cash outlay every single time the stock price drops and new equity is issued. The history here isn't theoretical, it's absolute proof of the structure's purpose. We're talking about a cumulative reverse stock split ratio of 42 million to 1. That's from early 2019 to late 2025. I mean, that level of mathematical devastation just demonstrates the structure is designed to wipe out the legacy flow and refresh the shareholder register every few years. It ensures common holders never accrete value over time. And we can't overlook the persistent cash drain from the senior preferred stack. The Series D preferred stock pays a massive 13% annual dividend, paid in cash. This obligation necessitates constant capital raising, which feeds the very dilution engine you need to fund those pivots you praise just to service the preferred stack, not to invest in real growth for common equity.
I understand the history is difficult to look past, but the current market environment offers a different dynamic. Let's focus on the access to value now. The deep discount to that stated 47-cent NAV, which is underpinned by 72.5 million in liquid Bitcoin, provides a powerful theoretical floor that frankly didn't exist before. For value investors, or even just tactical traders, this massive dislocation is the core investment case. If Bitcoin enters a true parabolic phase, the common equity, especially with the smaller float post-split, offers enormous immediate torque. We have to look at the asset base not just as a balance sheet entry, but as a genuine liquid opportunity for upside capture that could potentially outrun the structural gravity.
I would argue that theoretical NAV is a mirage if the common equity sits at the absolute bottom of an extractive capital structure. Let's treat this like a business balance sheet waterfall. Yes, they have 72.5 million in BTC, but that asset has to first satisfy the claims of the Series D preferred holders. That 13% cash draining dividend ensures that those assets or new equity must be constantly drawn down or printed just to service the senior stack. The structure confirms the value is designed to flow up the chain to preferred holders and creditors, not down to the common shareholder. I mean, think of that Bitcoin as treasure buried under a permanent, high-interest expanding mortgage held by the preferred shareholders. Until that toxic preferred stack is eliminated, the common stock is just a call option on dilution.
Okay, let's transition to the strategic rebrand.
With NVIDIA adjacent AI infrastructure, looks less like a strategic shift in core operations and more like the primary business is just the sale of equity, fueled by whatever the prevailing market narrative is. We've seen this cycle before, haven't we? The pivots happen roughly every 18 to 24 months, aligning perfectly with the latest macro themes. It was defense, then EV charging, then crypto mining, and now it's AI. It really seems like they're just following the capital flows and valuation multiples in the market rather than building a stable, sustainable business.
I think that claim simplifies the reality a bit too much. While frequent pivots are certainly unusual, agile adaptation can be a corporate virtue in high-velocity markets. The shift to high-performance computing is concrete. We aren't just talking about press releases here. They're focusing on the Centenum data center, and they've made tangible investments. Specifically, they ordered 2,000 high-efficiency Bitmain S21 Pro units. That is real capital commitment. This transforms the business from, a collection of legacy industrial assets into a high-growth infrastructure play. The AI label, while maybe aspirational right now, it acts as a necessary valuation multiple expander, something the defense subsidiary could simply never achieve. You need the narrative to unlock institutional attention.
But you have to examine the mechanism used to fund this agile adaptation, because it just highlights the conflict of interest. Have you considered the circular financing mechanism that involves Chairman Alt's private entity, Alt and Company? The company's reliance on Alt and Company to purchase up to 100 million in Series H preferred stock, ensuring that the chairman's private entity maintains seniority in the capital stack?
Some would call that an alignment of interest.
I see it as structural control. The capital is provided on terms, specifically the full ratchet in seniority, designed to benefit the provider who just happens to be the private entity of the chairman. This locks in seniority and punitive anti-dilution provisions. It proves the primary goal is control and protection for the insider, not maximizing returns for the public float. I mean, why should common shareholders trust a structure where the biggest capital provider is also the one most protected against dilution?
The counterargument is that without that commitment, the company wouldn't have access to the capital to acquire assets like the Bitcoin treasury, which is the singular element providing this deep discount and volatility torque we're talking about. It's the price of entry. But let's move away from corporate structure and look at market mechanics, which is where traders find their edge. I believe the stock's volatility is driven by directional retail interest, the so-called deep value bulls you see on social media. They view this stock as a potential squeeze play. They cite management's actions, like hiring firms to combat alleged illegal trading, as evidence the company is fighting for them. Crucially, the small float post-split offers genuine potential for explosive, though maybe fleeting rallies if any significant directional money comes in.
I'm sorry, but I just don't buy that the price action is driven by directional retail. The evidence from technical flows points to institutional hedging, which is far more systematic and, well, punitive. Let's look at the microstructure. Forensic analysis shows this stock is dominated by trading in alternative trading systems, or dark pools. Short volume ratios in these pools consistently hover between 40 and 50%. That shows that nearly half the off-exchange volume is initiated by institutional short sellers. And why are they shorting? This volume is driven almost exclusively by convertible arbitrage strategies. Arbitrageurs buy the convertible notes, the very Series C and H preferreds we discussed, and they immediately short the common stock to hedge their conversion rights. They're locking in the guaranteed profit spread between the deeply discounted conversion price and the market price, regardless of the stock's direction. This mechanism ensures two things: persistent, systematic selling pressure that caps any rally, and a continuous supply of synthetic shares flooding the market.
Wait, but if the Bitcoin treasury suddenly doubled in value, jumping from 72.5 million to, say, 150 million, wouldn't that massive asset appreciation fundamentally change the arithmetic for those arbitrageurs? Wouldn't the potential upside torque on the common stock finally outweigh the structural impediments and force some shorts to cover?
The mechanics of the full ratchet provision prevent that. If the common stock starts a significant run, management is incentivized to launch an ATM offering at a slightly lower price to fund operations. The second that new equity is issued below the Series CH preferred conversion price, the full ratchet kicks in, dropping the conversion price for the note holders. Their profit margin is instantly protected, and their potential share count geometrically increases, which requires them to simply short more to maintain their hedge. The structure is self-correcting in favor of the arbitrager. The proof is that the stock frequently appears on the regulation SHO threshold list, indicating high fails to deliver. Fails to deliver confirm that the supply of stock is often synthetic, stemming from sellers, specifically those hedging note conversions, being unable to deliver physical shares. The common stock is treated by institutions as an instrument for arbitrage, not as an equity growth vehicle. This perpetual synthetic supply prevents the kinds of organic price discovery you're hoping for.
That analysis confirms the high-risk nature, but risk doesn't negate opportunity. We agree the structure is engineered for arbitrage, yet that high volatility creates sharp tactical opportunities. If you look at the potential for a run-up based on Bitcoin price appreciation, a macro driver entirely outside the company's control, combined with predictable momentum from retail, a sharp trader could capitalize on that. The valuation is simply too low relative to the liquid assets to ignore the potential for a temporary surge. It's a trade on dislocation, not a long-term investment.
The issue is that the structure ensures that temporary surge is monetized almost immediately by the issuer through ATM offerings and converted into shares by the preferred holders via that full ratchet mechanism, all at the expense of anyone holding common shares directionally. The common shareholder ultimately bears the cost of providing the liquidity for the preferred holder's guaranteed profits.
To summarize my position, while I fully acknowledge the profound risks here, the complex capital stack, the history of dilution, the bias toward preferred holders, the material evidence of substantial liquid assets,
specifically that 72.5 million in BTC and a stable defense revenue base, well, it provides a fundamental floor and a strategic value proposition that is compelling at the current price. The stock's potential torque to a rising Bitcoin and AI market, especially with the discount to the NAV, makes it a unique, high-risk, high-reward play for tactical traders. The opportunity exists if you can navigate the complexities with precision.
And my conclusion remains firm. The paradox here is that valuable assets exist, but the sophisticated capital engineering defined by the full ratchet dilution and the priority given to senior preferred holders structurally impedes common shareholder value. The market microstructure confirms the stock functions primarily as an instrument for convertible arbitrage, ensuring the long-term cycle of dilution and reverse splits is statistically likely to continue. Investors have to distinguish between the tangible asset base and the, frankly, inaccessible, structurally impaired value of the common equity.
And I think this discussion really serves to illuminate that crucial distinction between accounting value, the tangible assets on the balance sheet, and shareholder value, which is the common equity's capacity to actually retain that value. Listeners have to weigh the undeniable asset base against the powerful financial gravity exerted by this very complex and, you can argue, extractive capital structure.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.